$16.1 billion Q2 surge. Is Intel's AI growth built to fail? Intel's $16.1 billion Q2 revenue growth urges businesses to strengthen their AI strategy and build lasting value. Intel just delivered $16.1 billion in second quarter revenue, growing 25% year over year. And if you only celebrate the headline, you could completely overlook the bigger strategic risks still threatening long-term profitability. The company also reported adjusted earnings per share of 42 cents, beating the expected 21 cents, proving that strong execution can temporarily impress investors while deeper structural issues remain unresolved beneath the surface. Investors rewarded the announcement with an approximately 9% after-hours share price increase. But you should remember that short-term market excitement rarely guarantees sustainable competitive advantage over multiple business cycles. Revenue exceeded analyst expectations of $14.4 billion, showing stronger commercial momentum than forecast. Yet you should ask whether extraordinary quarterly performance can consistently translate into durable shareholder value over time. Intel's data center and AI business generated roughly $6.26 billion during the quarter, highlighting how AI infrastructure spending continues driving enterprise demand despite tighter capital allocation across many industries. The Client Computing Group contributed approximately $8.88 billion, demonstrating that premium processors with higher average selling prices can strengthen profitability when you prioritize value instead of chasing shipment volumes. Enterprise customers continue investing aggressively in AI infrastructure, proving that when your business treats artificial intelligence as strategic infrastructure rather than optional technology, long-term competitiveness becomes significantly stronger. AI investment is expanding across hyperscale cloud providers, governments, manufacturers, and software companies, reminding you that digital transformation has become a strategic necessity instead of a discretionary technology expense. Intel's server processor demand exceeded manufacturing capacity, showing that strong customer demand means little if your production capabilities cannot consistently keep pace with rapidly expanding market opportunities. The biggest challenge remains Intel's foundry business, which generated approximately $5.77 billion in revenue, while still recording an operating loss of around $2.09 billion, exposing a serious profitability imbalance. If your manufacturing division generates billions in revenue, yet still loses $2.09 billion, you should recognize that scale alone cannot compensate for weak operational efficiency and capital productivity. Semiconductor manufacturing requires enormous capital investments, meaning your long-term success depends on utilization, customer acquisition, technology leadership, and disciplined financial management rather than impressive quarterly revenue alone. L-Impact Solutions believes Intel's quarter represents meaningful operational progress, but you should avoid interpreting one strong earnings report as proof that a complete corporate turnaround has already occurred. Intel projected third quarter revenue between $15.8 billion and $16.8 billion, exceeding analyst expectations, signaling management's confidence that AI-driven commercial demand will remain resilient in the coming months. Management also increased 2026 capital expenditure guidance from about $18 billion to more than $20 billion, showing that future growth now demands significantly larger financial commitments and disciplined investment execution. Whenever your company increases annual investment beyond $20 billion, every dollar must produce measurable strategic returns because capital discipline becomes more valuable than aggressive expansion alone. Intel's foundry business represented roughly 36% of consolidated revenue, yet remained unprofitable, reminding you that revenue contribution does not automatically create financial sustainability or attractive operating margins. Semiconductor fabrication facilities often require utilization rates exceeding 80% to 90% before fixed costs are efficiently absorbed, making factory productivity one of your most critical financial performance indicators. AI demand currently supports Intel's recovery, but you should never allow one technology trend to dominate your entire growth strategy because concentration risk eventually weakens long-term resilience. Intel's data center and AI business achieved approximately 59% year-over-year growth, confirming that AI remains a powerful commercial driver while simultaneously increasing dependence on a single high-growth technology cycle. Management indicated AI-related activities now contribute roughly 70% of momentum across several strategic segments, encouraging you to diversify before excessive dependence creates future operational vulnerability. If hyperscale customers reduce spending, export restrictions tighten, or alternative AI architectures emerge, your growth projections could change dramatically despite today's impressive financial performance. Global semiconductor competitors continue investing tens of billions annually across manufacturing, advanced packaging, lithography, AI accelerators, and software ecosystems, making execution discipline your strongest long-term competitive advantage. Winning semiconductor markets today requires more than faster processors because your success increasingly depends on manufacturing excellence, supply chain resilience, ecosystem partnerships, and lower total ownership costs. L-Impact Solutions emphasizes that sustainable shareholder value will come from reducing foundry losses, improving utilization, attracting external customers, and converting AI demand into consistent recurring cash flow. Strong revenue growth becomes far more valuable when your business simultaneously improves return on invested capital, free cash flow generation, manufacturing productivity, and long-term operational efficiency. You should never approve semiconductor expansion simply because AI demand appears strong today, since capital-intensive industries punish poor investment decisions for many years afterward. Every additional $1 billion invested should be evaluated against utilization forecasts, customer commitments, operating cash flow, depreciation schedules, and expected returns throughout a 5 to 10-year investment horizon. Your organization should establish minimum investment thresholds by targeting stronger ROIC, shorter payback periods, and factory utilization consistently above 85% before expanding manufacturing capacity further. Intel's $6.26 billion AI revenue and $8.88 billion client computing revenue together represented nearly 94% of reported revenue before eliminations, highlighting the importance of broader customer diversification. You should expand beyond AI by serving automotive, industrial automation, telecommunications, healthcare, aerospace, robotics, defense, financial infrastructure, and government modernization to reduce cyclical business exposure. Manufacturing productivity should improve faster than revenue because every 1% increase in wafer yield, equipment utilization, or process efficiency directly strengthens margins without requiring equivalent sales growth. AI-powered predictive maintenance, factory automation, digital twins, advanced analytics, and smarter supply chains can help your manufacturing network reduce costs while improving operational consistency. Premium AI processors generate stronger average selling prices, but your long-term profitability improves when networking chips, enterprise CPUs, embedded systems, software, packaging services, and foundry operations all contribute meaningfully. Balanced product portfolios reduce dependence on hyperscale cloud customers while strengthening recurring enterprise relationships across multiple industries and economic cycles, making your growth strategy more resilient. Financial governance should remain disciplined even during expansion because rapid revenue growth often hides weakening operational efficiency, rising capital intensity, and declining long-term investment returns. You should release future capital spending only after achieving measurable customer contracts, utilization improvements, gross margin expansion, operating cash flow targets, and stronger free cash flow conversion. Executive performance should measure operating margins, ROIC, utilization, inventory turnover, innovation productivity, customer concentration, and cash generation instead of rewarding quarterly revenue growth alone. Modern semiconductor risk extends beyond financial performance because your organization must also prepare for cybersecurity threats, export restrictions, geopolitical uncertainty, energy shortages, and supply chain disruptions. L-Impact Solutions encourages you to integrate operational, technological, geopolitical, cybersecurity, and financial risks into one enterprise governance framework capable of supporting faster strategic decision-making. Semiconductor fabrication assets often remain productive for 10 to 20 years, meaning poor investment decisions today can damage profitability and shareholder returns for more than a decade. Before expanding production capacity, you should stress test investment plans against demand declines of 10%, 20%, and 30% to strengthen resilience during future market volatility. Quarterly scenario planning helps your leadership respond faster to slower AI adoption, weaker hyperscale spending, stronger competitors, export restrictions, or macroeconomic downturns before problems escalate. Businesses capable of adjusting procurement, production schedules, and capital investment within 1 or 2 quarters usually protect stronger balance sheets than slower-moving competitors. Semiconductor manufacturing depends on advanced lithography equipment, specialty chemicals, silicon wafers, rare materials, packaging technologies, and precision tools supplied through highly concentrated global ecosystems. You should diversify suppliers across multiple regions, maintain strategic inventories, strengthen logistics visibility, and continuously monitor critical vendors to reduce operational disruption during future supply chain shocks. Human capital deserves the same strategic attention as factory investments because semiconductor innovation increasingly depends on AI engineers, automation specialists, cybersecurity experts, and advanced manufacturing professionals. Continuous workforce development, technical certifications, research partnerships, and leadership succession planning help your organization sustain innovation while strengthening long-term competitive positioning. Independent capital review committees should evaluate investment economics, manufacturing milestones, technology readiness, customer commitments, and post-investment performance before approving major strategic projects. Regular audits of utilization, ROIC, operating cash flow, free cash flow, and manufacturing productivity help you identify operational weaknesses before financial losses become significantly more difficult to reverse. You should recognize that one exceptional quarter never eliminates years of structural challenges, because sustainable transformation demands consistent execution across capital allocation, manufacturing excellence, and financial governance. When you evaluate semiconductor companies, look beyond exciting AI headlines and ask whether profits, utilization, free cash flow, and returns on invested capital are improving together over time. You can protect your business from costly investment mistakes by demanding measurable customer demand, disciplined spending, diversified revenue, and stronger operational accountability before approving aggressive expansion plans. L-Impact Solutions encourages you to measure long-term business success through durable cash generation, resilient operations, disciplined governance, and sustainable shareholder value instead of short-lived market excitement. Intel's 25% revenue growth, $16.1 billion quarterly sales, 42 cents EPS, and approximately 9% stock surge demonstrate meaningful progress, but your strategic evaluation should extend far beyond quarterly headlines. The company's $15.8 billion to $16.8 billion third quarter outlook and more than $20 billion capital spending plan reflect confidence, yet execution quality will ultimately determine long-term investment success. Manufacturing leadership increasingly requires continuous investment in automation, advanced process technologies, engineering talent, packaging innovation, and resilient supply chains rather than isolated product launches. Your organization creates stronger enterprise value when AI-driven opportunities consistently generate durable cash flow, higher ROIC, diversified customer relationships, and operational excellence across multiple technology cycles. The biggest lesson from Intel's performance is that sustainable growth always comes from balancing aggressive innovation with disciplined capital allocation, manufacturing efficiency, governance, and long-term financial accountability. If you consistently prioritize profitability, utilization, free cash flow, customer diversification, and disciplined execution alongside revenue growth, your business will be better positioned to create lasting competitive advantage. Is your AI growth strategy hiding a multi-billion-dollar profit trap? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.